Hey folks, Frank Zorrilla here, Zor Capital, the 21st, Sunday, the 21st of April, almost 7 o'clock Eastern time. Just a quick video about what's going on. So we all know the market had a very small correction. So far, the S&P 500 it's down about 5.61% from its 52-week high. The RSP, which is the equal weight, is down 5.88% from its 52-week high, but up only 1.25% for the year versus 4% for the S&P 500. The QQQs so far down 7.75% from this 52-week high, up only 1.25% for the year, and the equal weight is down 7.84% from its 52-week high, just less a month ago, and it's down 2% for the year. We finally had a correction that actually involved the indices. We've been having the correction underneath the surface for a long time, right? You see on Twitter, all these people, they talk about the market, the S&P 500 in general terms, right? Oh, the market is down 5%. If you only own the market, that's fine. It's not a big deal. But individual stocks underneath the surface have corrected and have been correcting for the last few months. But these 7 stocks or a few stocks have kept the indices up. They finally got hit, right? NVIDIA and a few others, ARM Holdings, Meta, Amazon, Google. They finally got hit, SMCI, on Friday. And you saw a reaction in the major indices, the QQQs down 2%, SPY down 0.87%. But the IWM, which was one of the first ones that corrected, was actually up. The DIA that doesn't hold some of these stocks only has 30 stocks. That was up 0.5%. So the point is that we finally got a correction. We finally saw a correction that can be seen in the indices, right? People are talking about breadth. Oh, breadth is so horrible. Stocks are down so much. Yeah, they're down so much because they've been down for the last couple of months, right? And they finally, and now finally you see it. I mean, if you look at, for example, stocks above their 40-day moving average, that's at 28%, okay, from 70 on 328. This correction just started you can kind of say a few days ago, but the point is it got to the generals. NVIDIA was down big, about 2 times, almost 3 times its ATR. SMCI, I think the ATR, I think is $63 the last 14 days, down $214. So, finally, when you finally get to the last man standing, you can maybe get a bottom. But again, we're down roughly 5% from the highs. This is all normal. Okay, here's what I mean. The average intra-year decline on the S&P 500 for the last, call it, 44 years, the average pullback is about 14.2%. Some years higher than others, whatever the case may be. 48% in 2008, 25% I believe in 2022 that people forget. It was just the other day. So it's roughly about 14%. Usually, you take some of those outliers out of the way, it's more like 10%. So all this is normal, right? You go back and you look at, let me see, what else do I have here? So that's normal. 5% pullbacks, that's normal as well, right? So what we might want to look at for a potential bottom is you start looking at the 30-minute chart. And here I have the 30-minute chart with the 5-day moving average, 21-day moving average, and the 10-day moving average. You see how they're all curling down, right? And what you typically see is some type of inverse head and shoulders pattern develop in the 30-minute charts, right? And then you start to see these averages, they start to flatten out. And once they start to flatten out, sometimes you get a nice gap higher. Sometimes you get a nice gap higher, like we did over here. But then it couldn't hold the 5-day moving average. And here you see more back and forth. But here we got a nice gap higher that immediately goes back and retests that 5-day moving average, and then it bounces off of that 5-day moving average for, really hard, and it stays above for a while. And that's exactly what we're looking for here. That 5-day moving average right now is trading at roughly at 502, so it's got ways to go, right? So we can get a bounce here, and you can play that bounce and then use this low here, whatever the low is, as your stop. But I think sometimes you're better off just waiting for it to go back and forth, allow these things to flatten out, and then you normally get a gap up and then a quick gap down retracement to that 5-day, then you get a bounce, okay? Also, if you wanted to play this bounce, your best bet is always the market, right? It's always the market. I know people look at relative strength, but the fact of the matter is, when you have a correction, this is not a correction, this is a small pullback, but normally when you have a correction, what goes up first is what was beaten up the most. And I'm not a big fan of using relative strength based on 1 to 2 days, okay? Because 1 day does not make a trend, although a trend starts always with 1 day. But 1 day relative strength means nothing at all. If you see relative strength throughout weeks and stuff like that, it's a different story. That's more reliable. But again, we're looking for some back and forth action. We're looking for these moving averages to flatten out, specifically the 5-day moving average. And once we get above, then if you want to play that bounce or get aggressive on that trade, my first recommendation is and will always be the SPY, the Qs, or the SMH, right? One of those, or the FANG. As far as long term, listen, the indices have a track record so far of going higher over the long term. I'm a fan of buying the indices forever, especially within pullbacks. Okay, you get that average 15%, your average 15% pullback in the S&P 500. I believe that's buyable. Okay, you don't get it so often, but I have a YouTube video out there. You can search for it. Holding holding market ETFs as core holdings. I think that's the way to go. And again, if you look at, for example, there are always different things happening throughout history why the market pulls back for many different reasons. All right, COVID, JFK assassination, Cuban Missile Crisis, we bombed Iraq. Deficit, QE stops, raised interest rates, CPI is always a reason. But when you looking to hold on to the SPY and buy the market, you're thinking long term. So since you're thinking long term, you can even go in with a random entry because your time frame is forever. Okay. So again, just to reiterate and to conclude this video, what has happened is normal. We have a 5% pullback. We've had many pullbacks of 5% or more over the last couple of years. I'm going to show you a quick chart. But before then, let's take a look. While I look for it, let's look at Bitcoin. Bitcoin also can hold clues, which I said this on Friday on Twitter, right? This one holds clues. This is a 24/7 market. It's really not, people say, it should go up when we're going to war or whatever the case may be. It's just a liquid market that gives people the opportunity to trade and raise cash or not raise cash 24/7. And so far, we got above that 5-day moving average right over here on Friday. We held it. Now we bounced off of it. So now you can assume that it supports for now. But as far as the pullbacks, here we have S&P 500 corrections since 2009. We got a bunch of them. Days average about 26. The average decline has been 7.6%. And here are the reasons why. Many reasons why. So you can go back to these dates and then start looking at some of these dates and to see if you see any patterns and outlay the 5-day moving average to see if using that as a barometer to get in actually works. All right. So again, this is all normal. It can get, a lot bigger than this. For those who don't own the market in their long-term account or any account for that matter, this is exactly when you want to start looking at perhaps buying the SPY and the Qs with a long-term horizon, and with the intentions of buying more as they go down, right? So let's say, for example, we're down 5%. I have someone who doesn't have to SPY. Maybe I'll go in and buy 1% and look to buy more. If we get above the 5-day moving average, I might get aggressive and buy more for a trade. But if we start at 5%, that 5% turns into 10%, then I'm going to buy more. If it goes down to 15%, then I'm going to buy more. Okay? And you start to scale in, and that's the market rebounds. If you end up with a 20%, 25% allocation as the market rebounds, and you want to keep that allocation at 25%, once that number becomes 28, you sell 3%, right? And then if it goes up again to 28, 27, you sell 2%. You keep it at 25%. That's the way to do it. All right. So trade them well and be well.